Imagine waking up one morning to discover that the world's safest economy just pulled the pin on a financial grenade. A country known for precision, stability, and discipline suddenly made a move so unexpected that even global banks, hedge funds, and central banks weren't prepared for it. A move that could send shockwaves through interest rates, energy markets, currency stability, and even the backbone of global trade. A move so subtle that most people didn't notice it happening, yet so powerful that its impact could reshape the financial architecture of the next decade. The country, not the United States, not China, not Russia. It's Germany. The same Germany that rebuilt from the ashes of World War II. The same Germany that engineered the European Union's financial stability. The same Germany that served as the backbone of global manufacturing. And yet, Germany just did something quietly, deliberately, and under the radar that financial analysts are calling the most dangerous economic shift in Europe since 2008. Today, you're going to learn what Germany just did, why it matters, how we reached this moment, and why the ripple effects could break the global economy as we know it. But to understand the danger, you first need to understand the story. A story that begins not in 2025, but more than a century ago. Let's start from the beginning. The history behind the current crisis before we talk about what Germany just did. You need to understand why Germany matters so much. Germany is not just another country. It is the beating industrial heart of Europe. It is the fourth largest economy in the world. It is the anchor that holds the European Union together. And its impact is woven into energy systems, currency, strength, global manufacturing, and geopolitical alliances. Germany's rise and its current crisis can be traced through four major financial eras. The post-World War to rebirth, the export machine era, the Eurozone architect phase, the energy dependency trap. Each one quietly planted seeds that are now exploding. Let us walk through them, because each era creates a cause and effect chain that leads to Germany. Shocking recent action. The post-World War II rebirth. When stability became a national obsession after World War II, Germany was devastated. Cities flattened. Banks collapsed. The currency destroyed by hyperinflation. From this ruble emerged a new German mindset, an obsession with stability, fiscal discipline, and industrial strength. This era gave birth to the German Central Bank, a culture of low debt, a manufacturing-first economic identity, strong worker protections, the idea that inflation is the greatest economic enemy. This stability-first worldview shaped every financial decision Germany made for the next 80 years. But there was one flaw, a flaw that would come back decades later. Germany was rebuilding, yes, but it was also becoming dangerously dependent on external resources, especially energy, and that dependency would eventually explode. The export machine era. How Germany became the world's factory by the 1970s. Germany evolved into the world's most reliable export powerhouse. Germany produced the world's best cars, the world's most precise industrial machines, chemicals, steel, pharmaceuticals, and high-end electronics. This wasn't luck. It was strategy. Germany built a system where the government supported manufacturers' workers were highly skilled. Energy was cheap. Long-term planning was prioritized. Savings rates were high. Consumer credit was low. Competition was encouraged. Germany became an industrial giant while avoiding the consumer debt-driven model of the United States. But again, this success masked a vulnerability. German industries consumed massive amounts of energy. Energy Germany did not have. The Eurozone architect phase. Germany quietly shapes a continent. Germany was not just a strong economy. It shaped the entire European Union. When the euro currency was created, Germany's influence dominated the fiscal rules, the interest rate philosophy, the debt restrictions, the inflation targets, the trade systems, in fact. Germany essentially exported its economic identity to every EU nation. Countries like Italy, Greece, Spain, and Portugal, which historically relied on high spending, inflation, and debt cycles, were suddenly forced to operate under German-style discipline. Germany was the anchor. Germany guaranteed the system. Germany kept the euro strong. But this also meant one thing. If Germany ever stumbled, the entire eurozone would stumble with it. And that brings us to the final piece of this puzzle, the energy dependency trap. Germany's biggest mistake. Germany built the world's strongest manufacturing economy, using energy it didn't produce. Germany became dangerously dependent on Russian pipeline gas. Imported oil, imported coal, nuclear power until it shut it down. For decades, Germany believed energy prices would stay cheap. It believed geopolitics would remain stable. It believed the Russian gas lifeline was safe. This belief collapses in 2022. When Russia cut gas flows to Europe, German industries panicked. Factories shut down. Chemical plants reduced output. Electricity prices soared. Inflation hit decades-high levels. Businesses left Germany for the US and Asia. This was the first crack in the system. Germany, the world's industrial titan, suddenly looked fragile. But nobody could predict what Germany would do next. The breaking point to what Germany just did, and now we arrive at the moment that sent shockwaves through the financial world. Germany just announced a massive structural shift that threatens global markets. Germany quietly abandoned its post-war fiscal stability model. For the first time in modern history, Germany suspended its debt brake, a constitutional rule that limits government borrowing. T's rule wasn't T. Just a financial guideline. It was the foundation of German economic identity. Its removal signals that Germany's preparing for economic emergency measures. Germany expects long-term industrial decline. Germany anticipates higher inflation. Germany is losing faith in traditional stability policies. Germany may no longer guarantee EU financial safety. Germany may stimulate aggressively. Breaking global equilibrium. Germany essentially told the world, we can no longer protect the old system. We must save ourselves. This move triggered fear. Global bond markets, European banks, AO regulators, international investor-export economies, currency traders. Because when Germany abandons stability, the world loses its anchor. Cause and effect. How we got here. To understand why this move is so dangerous, we need to follow the cause and effect chain. Effect number 1. Germany's industrial base is shrinking. For the first time in 50 years, Germany's manufacturing output is declining. Energy prices are too high. Labor is too expensive. Regulations are too strict. Global demand is slowing. Supply chains move to Asia. German factories, once the pride of Europe, are now closing, downsizing, relocating to the US, moving to China, becoming less competitive. The economic engine is sputtering. Effect number 2. Germany can't afford its social system. Germany has an aging population, a shrinking workforce, low birth rates, high pension obligations, soaring healthcare costs. Under the old fiscal rules, Germany simply did not have the money to sustain these systems. Suspending the debt brake gives Germany the ability to borrow like southern European countries have for years. But this has consequences. Effect number 3. The Eurozone Stability Pact is dead. Germany was the nation enforcing fiscal discipline across Europe. Now that Germany itself broke the rule, other nations will demand the same freedom. Eurozone debt levels will rise. The euro will weaken. Inflation pressure increases. The European Central Bank becomes trapped. Germany removed the anchor, leaving the ship adrift. Effect number 4. Global markets lose confidence. Investors believed Germany would always remain stable, disciplined, predictable, conservative, safe. With the shift, investors suddenly question, will German bond yields rise? Will Germany borrow uncontrollably? Will the euro become volatile? Will inflation return? Will the EU face another debt crisis? Confidence is fragile, and Germany just cracked it. The fallout. Why this could break the global economy. Germany's decision doesn't just affect Germany. It affects the entire world. Here's how. The euro could enter a crisis. The euro is the world's second most important currency. If Germany weakens, the entire currency bloc weakens. Import prices rise. Inflation becomes sticky. Borrowing costs spike. Governments struggle to repay debt. Investors Flee to the dollar or euro crisis. Gives global currency instability. European banks are at risk. European banks hold massive German debt. If that debt becomes riskier, banks lose stability. Liquidity shrinks. Lending freezes, business investment falls. Recession spreads banking risk, gives manufacturing collapse, gives global recession. German exports decline, crushing global supply chains. Germany exports cars, machinery, chemicals, electronics, pharmaceuticals. If factories shut down or move overseas, global supply chains shatter. This impacts China, Turkey, Eastern Europe, South America, even the US. The world depends on German machinery. If Germany slows, global industry slows. The US dollar becomes even stronger, causing global pain as confidence in Europe falls. Investors run to the US dollar. A stronger dollar crushes emerging markets, increases oil prices, raises global debt costs, makes trade more expensive, weakens global growth. The world becomes more dollar-dependent than ever. And an overly strong dollar is historically a trigger for global crises. A new global power shift begins. Germany's move signals an end to the economic model that dominated the last 50 years. The new winners will be energy-rich countries, commodity producers, low-cost manufacturing hubs, nations with younger populations. The losers, aging, energy-dependent, highly regulated economies, especially those in Europe. This shift could reshape global alliances for decades. Modern parallels. History repeats itself. Germany's decision echoes three historical moments. The 1970s oil shock, energy dependency destroyed industrial competitiveness, just as today. The 2008 debt crisis, small cracks in the financial system cascaded into global collapse. The 1920s, 1930s European debt crisis, inflation, political instability, and currency fragmentation. The same pattern is forming now. History doesn't repeat itself exactly, but it rhymes. Germany's move is the first domino. If you remember nothing else, remember it is Germany abandoning its fiscal rules signals a global turning point. This is not a minor policy change. It's a complete reversal of 80 years of economic discipline. The ripple effects could trigger a worldwide financial realignment. Currencies, trade systems, debt, markets, energy flows, global alliances. Everything will shift because Germany shifted. The global economy is entering a new, unpredictable era. Old assumptions no longer apply. The world's financial map is being rewritten in real time. Germany just did something that no one expected. Something small on the surface, but seismic beneath it. Something that could break the global economy not instantly, but gradually, through cascading shocks that spread from Europe to the rest of the world. We are living through a financial turning point. The next decade will not look like the last one. And the decisions governments make today will shape the world our children grow up in. If you want to stay ahead of these shifts, if you want to understand the deeper forces that move money, power, and nations, then you need to keep watching, keep learning, and keep questioning the official narrative, because the truth is always hidden beneath the surface. This is the history of finance, and the next chapter is just beginning. If you found value in this breakdown, subscribe, like, and share this video to help others understand the story behind the headlines. I'll see you in the next deep dive.